This is the third in our series of lectures about the business cycle, and this one's offered only in video. I'm not going to give this lecture in class. Remember, we did this because we wanted to wait for the 2019 National Income and Product Account data to come out, and that has happened, and so now we can use numbers for all of 2019 to complete this lecture. This is mandatory, but again, it's not going to be offered in class. So let's take a look at what that data that was released just a few days ago indicates about the nature of our cyclical activity in this economy. We're going to pursue this mostly by breaking down the NIPA accounts into the various components to see which are contributing most to the cycle. We're going to do that first using visualization, and then we're going to do it at the end by going back and taking a look at some data and some standard methods for using data to evaluate cyclical contributions. I introduced that a little bit in an earlier lecture in class. I'm going to reproduce that completely here because it is a little difficult to understand if you don't have a background in statistics. So let's get this underway. You've seen this graph before in a previous lecture, but it did not have the business cycle troughs in the previous graph. And so what we're looking at here is real GDP growth quarter by quarter annualized between 1960 and 2019. And you can see the periods there which were regarded as recessionary. For example, in 1974-75, 1981, and 2009 or so. That's where the graphs go below the zero reference line. And for this, we're using our own crude definition of what constitutes a business cycle, or a downturn at least. And that's when we have 2 consecutive quarters of negative GDP growth. And you can see, as of course it's definitional, that the troughs of these downturns are associated with what we identified as the business cycle troughs earlier in the class. In that case, though, using the more sophisticated standard offered by the National Bureau of Economic Research. So our question is, what is contributing to this cycle when we break down these GDP accounts into their various subcomponents? Now, in the previous lecture, you may remember we broke down GDP into its 4 primary components: consumption, investment, net exports, and government purchases. And so that might be a useful method of doing the same here. Let's take a note, though, before we do, that the average growth rate for this economy in this time period shown here was a little above 3%, but the period between 1960 and 2000, that 40 years, averaged just a little under 4%, and the period since 2001 has averaged only about half that, at 2%. So that tends to confirm the observation we made that this economy's recoveries are lasting for longer and longer periods of time, more and more quarters, and we're currently in the longest recovery on record here in the year 2020 at the beginning, but the growth of the economy has been more or less cut in half. Now, let's move on down the line and take a look at the components of GDP, starting with consumption. And here we're dividing consumption into its 3 primary categories. Remember, durable goods, non-durable goods, and services. And those were defined in a previous lecture, so I'm going to count on you to remember those definitions here. And the purpose of looking at this is to note the relative volatility of durables and the stability of services. So the red line represents durable goods, and as you can see by looking at the axes, that there are extreme swings in durable goods orders, almost declines of almost as much as 8 or 9%, certainly more than 5% on a number of occasions, but bursts of growth above 10% upon multiple occasions, and one burst of growth, of course, in 1984 or so, close to almost 15%. In contrast, take a look at services. And aside from the period in the 1960s where it went a little bit above 5%, and then also at about mid-1970, a little bit about 5%, it has since then approached 5% a number of times, but tends to be around the 3 or 4% level. But more remarkable than that, services component has never actually had a recession if you take a look at it. Right there in 2009, it kind of dipped down below for data measured for the year, and so maybe that can be thought of as a very, very mild services recession. But services has remained remarkably non-volatile compared to durable goods. Now, non-durable goods are somewhere in between. Remember that durable goods are big ticket items like automobiles and furniture and appliances, and in some cases computers, but in other cases computers are linked in the investment category. And so it makes sense that they would be more durable than less expensive items like clothing and food and basic cost of gasoline and basic transportation and the like. And again, non-durable goods is somewhere in between, but really isn't much more volatile than services. Now this right here tells us something important, that given that services constitutes by far the largest weight in the GDP accounts, the stability of services is one of those things that is contributing to the stability of the U.S. economy at the present time. Now, consumption is driven by our income, and so if our income rises, services rise, non-durable goods rise, durable goods rise, because that's how we finance consumption. But in the modern era, to some extent, our access to credit and low interest rates that may be associated with credit during boom times also drive our consumption habits, because that's what drives the purchase of durable goods. Again, automobiles are subject to credit terms that we respond to. Our use of credit cards in general, of course, can also be used to finance the purchase of non-durable goods. And so our ability to go beyond our income by using credit is a factor in the modern era. Also, according to studies, our perceived wealth will influence our consumption habits. We've talked about this before, and I don't want to raise the issue very much again, but it amounts to our sense of how wealthy we are and how much wealth we control. And during a period when the stock market, for example, is rising, our perceptions of perceived wealth rises with that, and it causes a positive delta in consumption, which isn't too surprising. If our financial investments are doing well, then generally we're spending a little bit more. Also, we're going to be introducing ourselves, especially in the modeling section, which comes next, to notions of expectations. Expectations are the sense of where we think this is going to go next, and we're going to refine that in the modeling section a lot. So let's just leave this definition of it general right now, our sense of where this is all going. And if we have expectations of rising wealth or expectations of rising income, that can also cause present-day consumption to rise as well. Statistically, these relationships are in the modern era quite robust. Now, let's take a look at the behavior of investment. Now, as you might guess, the investment categories, which remember is not the same as the term's meaning in the vernacular, which you may think of as buying stocks and bonds. Instead, it's business purchases primarily of equipment and services, such as automobiles and trucks and the like for fleets, and for residential construction. So that is your contribution to investment. When you buy a home, it's not classified as consumption, but also business purchases of construction and the like are all included in this category. This, as one might guess, is way more volatile than consumption in general, and measurably more volatile than services. First of all, take a look at the range of this axis compared to the range of the axes on the consumption graph. This one, as you can see, ranges from minus 30 to 50. Going back really quickly to look at the consumption graph, that ranges from 20 to 15. And so 20 to minus 10, I mean. And so what we're looking at here is across a wider range. I should actually put this in full slide mode. So I'll do that now. Okay, there we go. This is across a wider range. This will be a little bit easier for you to see. And so the blue represents residential construction. That's your parents', your grandparents', others, not parents' purchases of homes, real estate, and the like. And you can see that's crazy volatile. That's the dotted blue line, ranging from an explosion in the 1980s to above 40% in 1 year to very grave and serious contractions, such as the contraction between 2006 and 2011 that troughed at about minus 25%, but was for that entire period well below zero. But also equipment purchases are volatile as well. Intellectual property products, which is mostly for abstractions such as patents, remains fairly stable. And business structures are volatile as well, more so even than, once again, consumer durable goods, but far less so than residential construction. But given that we're looking at extremes here of minus 25% to plus 40%, then clearly investment categories in general contribute a great deal more to the business cycle than does any category of investment except for possibly consumer durable goods. So we'll take a look at this statistically here in a few slides to see which of these makes the greater contribution. Keep in mind, however, that the weight for each of these is smaller. The amount of money we spend on services and consumption is quite high. It's almost 50% of GDP and almost 70% of consumption categories altogether, but the respective weights of all categories of investment have a lower weighting in the aggregate GDP accounts, and so even though these are more volatile, that volatile influence is muted somewhat by the fact that these have relatively small weights. And we'll look at those weights toward the end of this slide set. Now, we skipped a slide here. Okay, that's right. Almost skipped a slide here. Now, government purchases also are relatively volatile, although again we're using a narrower range. For the bottom of the trough to the top of the peak, we're going from minus 8 to 12, and so this is relatively mild, of course, compared to investment categories. You can see that federal government purchases, though, tend to be fairly volatile compared to state and local. And you can see that there have been swings in the federal purchases of goods and services, ranging all the way from about 10 to minus 6 in the late 1960s. Do remember, by the way, that this is just government purchases of goods and services. This does not include the all-important category of transfer payments, which are outlays by the government for such programs as Social Security. Those aren't included in the NIPA accounts because of the double counting nature. And so this is purchases for defense products, for roads and highways, and for basically tangibles and some services. Now, the comment down there in the bottom of the slide where it says automatic stabilizer is there because textbooks from recent years, really going back until the 1950s, have referred to government spending as a type of automatic stabilizer that helps an economy during a recession. The suggestion being that even when private business purchases and consumer purchases fall off, the government is still there to buy things during the downturn, and so that has a tendency to stabilize the economy because it's less volatile and more steady. If you're talking about the federal government, though, that's a doubtful argument because, as you can see, federal government purchases of goods and services is actually quite volatile. And I don't tend to subscribe to the notion that the federal government's purchases of goods and services have a stabilizing function. What has a stabilizing function in this economy is services. Now let's take a look at the hard data, and this will be, I think, even more indicative. Now, not all of you will understand this completely, And the method being described here is not something I'm going to ask you on an exam. And that's because your background in statistics is going to vary from one student to the next. Even it's going to depend in part upon the class you're in. If you're a first-year student, you're less likely to understand this, I think, than if you're a senior. Because by the time you're a senior, you may have seen this kind of analysis elsewhere outside of economics. But I think that nonetheless the result is fairly easy to understand, even if you're not entirely clear on the method. And some of you will actually understand the method, so let's plow through this. What we're going to do here is disaggregate gross domestic product into its constituent components, just like we did visually. And we want to compare average growth rates and the standard deviations for those growth rates for the components of GDP to GDP itself. Now, it's a little complicated to say we're going to be using continuous natural log growth rates because those are more suitable for a study like this. This may be the first time you've ever heard of a natural log growth rate, and I realize that could be a bit of a problem, but it's just another way of calculating continuous growth. It's very easy to do if you understand how natural logs work, and it's more reliable because its averages are not biased, as is the case with discrete growth rates. And so the continuous log growth rate shows the growing or declining importance of a component over time. So if, for example, services are growing at a much higher average than GDP, and consumer non-durables are shrinking over the same time, then obviously services is becoming more important in the U.S. economy. And we actually looked at a graph that displayed that in the last lecture. Now, standard deviations normalized to GDP standard deviation, or compared to GDP, shows the relative volatility of a component, which may add insight into the risk or the cyclical activity of that component. And so basically by taking comparative standard deviations, we're going to see if what we have identified visually as the most active and volatile components of GDP are confirmed in our evaluation of standard deviation. Now, by the way, in case you're curious about why we're using continuous natural log growth rates for this instead of discrete growth rates, then that is explained in another video that I prepared for another class, Economics 136, where I go through the actually how this is done, how the method is used, and why it is used. That is not assigned for this class, and you're not expected to know that, but in case you're curious about it, this link down here at the bottom will take you to that video. Now, what we're saying here is you can take any statistics in time series data, and you can calculate its mean growth rate. That's represented here by this little mu on this distribution. And we could say maybe that's something like a 5.462% in nominal terms over a period of 20 years, and this is the annual growth rate. Now, we can also take the standard deviation of that growth rate and say that that's a number like 0.03. And that doesn't mean anything yet, but it doesn't actually mean anything directly when you use the number. When you compare it to another standard deviation, then its meaning becomes apparent. So we're saying that if this, let's say, is kind of idealized mapping of the growth rate of GDP, and that measure of dispersion there around it is assumed to be a normal distribution and has a measurable standard deviation, then we compare the mean growth rate and standard deviation of all other components to that to see what is contributing to the cyclical nature of gross domestic product. Now, what we're going to use here, as I've said, is on the bottom, we're going to use the continuous log growth rate. When this says at the top of the slide, don't worry, be happy, I'm not going to ask you this. I'm not going to ask you this definition or this extension. The growth rate that you're most familiar with likely is a discrete growth rate, which is at the top shown there, and in this example is exactly 0.15 or 15%. And that's when you take, using the example of x aught, the first observation is 100, and x1 is equal to 115. Then it's x1 minus XOT divided by XOT, and that comes out to 0.15. The geometric discrete growth rate is simply the ratio of the two, but we're using the continuous log growth rate because it's a better estimator, and it's going to come out to a similar number but slightly smaller because it's actually implying continuous growth. It'll be about 14%. The continuous log growth rate using numbers like this is equal to the ratio of the natural logs. So that's the natural log of 115 over 110. And according to the log quotient rule, that is also going to be equal to the difference between the natural logs. Both of those come out to 0.13976, or about 14%. So that is a method we're using on our quarterly data going back to 1960 for the components of GDP. And again, I'm not expecting you to remember this part of the explanation. If I had all mutters in the class, I probably would expect it, but I realize some of you from the other colleges don't have the same math background as the majority of students in the class. Now, we're going to calculate the mean and the standard deviation from this log converted data. So in other words, we're calculating the mean of the log growth rate, not the mean of the original distribution. And we're calculating the standard deviation of the log growth rate, and not the standard deviation of the original data. So the mean value, of course, is the very elementary averaging formula, where you take the sum of all of the values and divide it by the sample size, and that's our mu. Then we can calculate the variance of the growth rate, which we're not using. The variance of the growth rate is equal to each observation minus our estimated mean squared, divided by the sample size, and that's our variance. And then standard deviation is always calculated as the square root of our variance. So what I did to undertake this study was take the mean value of the growth rate and calculate the variance and thereby the standard deviation of the growth rate to make these comparisons. Again, at the top of the slide, we say, don't worry, be happy. I'm not going to ask you this information, just the results. And this is the result. Now, I do expect you to try to figure out what this slide is telling us. Now, first of all, we're looking at gross domestic product, and we're leaving out, by the way, net exports, because that actually complicates the situation quite a bit, and it's not as easy to ask questions about net exports because one of the categories is negative, so we omit it from this study. And so the first column on the left says, what is the weight of this item compared to GDP? And so, of course, durable goods, remember, makes up only 7%, but in, this is 2019 annual that we're looking at, by the way. Services make up 47%. Residential construction only makes up 3.7%, and down the line, you can see that. And then the mean nominal continuous growth rate, nominal meaning we did not inflation adjust this data, and that's because it actually wasn't available going back to 1960. It's more current data if it's adjusted for inflation. So this is nominal continuous growth rates we're looking at. So gross domestic product grew at 6.2% continuous over this period of time. But again, that's not in real terms, that's in nominal terms. And that column doesn't tell us very much that's important, although we can see that some things are growing faster than others. Services, for the mean nominal continuous growth rate, stands at above 7%, so it's growing faster than GDP as a whole. And we can see that other categories are growing less fast. Now, what really matters is the standard deviation for all of these. And so when we take a look at the standard deviation of the quarterly log growth rate of gross domestic product, it's a number that doesn't mean anything by itself. And we're looking, by the way, at the top of the third column from the left, the column labeled CGR, continuous growth rate standard deviation. So you see gross domestic product at 0.00935. And say, well, okay, I don't know what that means actually. Durable goods, 0.02, you see that's a lot higher. Now, this becomes meaningful to us if we take the one on the top and use it to normalize the others. And so, for example, we divide 0.00935 into all of the others. And that tells you how all of these are performing relative to GDP. It shows you their volatility relative to GDP. So that becomes the all-important column that's on the far left of the big matrix. Now, obviously, 00935 divided into itself is 1. But the next one, durable goods, remember, which we identified visually as one of the most volatile categories, is confirmed to be volatile here. It has a value of 3.001, meaning as measured this way, the standard deviation of durable goods is 3 times higher than the standard deviation of GDP as a category in itself. So we say, well, we're going to classify that then as strong. And if you look down at the very bottom row, this says key, contributes to cycles. Blue is neutral, meaning it's the same as GDP. Green means it's going to be dampening the cycle. Orange means it'll be adding to the cycle. And red means that it's really substantially adding to the cycle. And that's kind of arbitrary there. So durable goods is the second most volatile category in this group. And we know, if we think back to the visualization we saw, that residential construction should be up there as well, remember? So looking down there, we see residential construction at 4.7, and that's even more volatile relatively than durable goods. And then non-residential construction is also high, also higher than durable goods. And then finally, equipment and software at 2.91 is contributing substantially to the cycle. But fortunately, when we go back and take a look at their weights, which again is in the column on the far left side, the residential construction component only explains 3.7% of GDP. The non-residential construction only 2.9, even less. Equipment and software 5.8, but also consumer durable goods at 3 times the standard deviation of GDP contributes only 7.1% to GDP. And so it turns out that the 3 most volatile categories of GDP have among the lowest weights in GDP, which is one of the reasons why the modern U.S. economy is so inherently stable. Now, to look at the other side, there's only one category that has the effect of dampening the business cycle, in that the standard deviation of that category of consumer durable goods is less than the standard deviation of the GDP, and the normalized number is 0.785, so it's a lot less. And we look over and see that's the category that explains 46.9% of GDP. That's the weight in that number. And this is one of the reasons why this recession has lasted so long, and why the modern day cycles that your parents have experienced, and certainly that you have experienced, are far more tame than something your grandparents or your great-grandparents experienced. Remember, when this class started, we went back and looked at cycles over a long period of time, and we saw the further back you go, the more volatile the economy was, the longer the recessions, the shorter the recoveries. But as we move into the modern era, then that has been dampened. And one of the reasons is because of our evolution into a services economy, where the most stable component of GDP is also the largest component, and where those elements of the economy that are very disturbing actually, fortunately, have low weights. So that really gives us a lot of insight into why this economy is so stable in the modern era. Remember, I was mentioning that our services constitute 46 or 47%. I think I said 46 or 48 because I don't actually remember the number, but this number here is the number for 2019. I just read over the weekend that the Chinese economy, the contribution of consumption is only 30% for that economy, that their investment categories and export categories, which I'm not showing here, are higher, which may mean that there's more potential for volatility in that economy than there is in this economy. Now, there's one more thing that we're looking at here, and that's the price deflator. And we haven't introduced this yet, but this shows where inflation has been found within these categories. I put this in here because it's easy to add. And so if the number is above 100, it means that that component has higher levels of inflation than GDP. If it's under 100, it has lower levels of inflation. So we can see that residential construction is inflating faster than GDP, but in this case, so is services. So services are actually rising in price higher than GDP as a whole. And that's partly because categories like non-durable goods are at only 88%. Now remember, I told you that the trend that we saw between services and, let's see if I can do this where we showed it. This was services and this was consumer durable goods going down, remember? And I said that was partly a pricing effect because we're looking at priced values and not real values in that data we were looking at. And that simply means that the prices of consumer durable goods has declined because of productivity measures, whereas the prices of services not so much. And so that also explains to some extent why services have grown in relative importance. Now here's a final slide that encourages you how to think about this and interpret it. GDP is an aggregate, and all of the other categories are components of the aggregate. Their weights vary from services, which constituted 46.9% of GDP. Let me check and make sure that I updated that correctly. Is that yes? It is correct. Good. To non-residential construction, which constitutes only 2.9. The volatility of GDP, which we here represent by standard deviations of the quarterly continuous growth rate, will be impacted by the volatility of its components, which we represent by the individual standard deviations of their growth rates. So that's what you just saw. Once again, in summary, two rules. The higher the volatility of the component relative to the volatility of GDP, the more that component is raising the volatility of GDP. And second, the higher the weight of the component, the more the impact. And you can probably see that in the math. Now, by the way, the mathematics of the sums of variances formula that we're using is down here below. In case you're wondering where that came from, you are not accountable for that. I'm really not going to explain it because most of you wouldn't understand it. But this is a formula that shows where you get the variance of an aggregate when you have the variances and covariances of the subcomponents. So that's there to just, for those of you who know the math, that's there to represent the math that we were looking at. So going back very quickly, this here confirms what we saw on our graph. We said, yeah, durable goods is relatively volatile, as is residential construction and the other class of construction. And going back to the visualization, we see that. It's clearly the residential construction that is contributing the most. And then when we go back to consumption, we see it there as well. We see services stable. We see non-durable goods relatively stable and durable goods very unstable. And so then when we look at the data right there, it tends to confirm it, all right? So mostly the result is what I want you to take away, and especially for the purposes of the exam. Okay, that should wrap this up in about half an hour. That wasn't too bad, actually.